Hello everyone, Alex Kim here. What we're watching in silver right now is not a price story that will be explained later by fundamentals. It's a structural moment where positioning is becoming visible before the narrative catches up. On Friday, silver closed just above $103 for the first time in history. Then yesterday, it pushed through 117.74 cents intraday, before pulling back sharply to around 102 to 103 by the end of the session. Gold moved in parallel, breaking above $5,100 and reaching $5,111 before retreating below $5,000 during the London evening session. This morning, as of 8 a.m. London time, gold is trading at $50.85, up $75 from yesterday's settlement with an overnight high of $51.01, while silver sits at $112.40, well above Friday's close but clearly off yesterday's spike. The velocity matters here because faster moves in commodity markets, and yes, these are monetary commodities, tend to produce not just bigger advances, but sharper and quicker corrections, which is exactly what we saw play out yesterday afternoon. One analyst, using Elliott wave methodology, is projecting gold at 8,400 and silver at 840 by summer, maintaining a 10-to-1 ratio, but emphasizing that the path includes significant volatility and steep corrections along the way. I'm not endorsing that forecast. I'm pointing out that the framework expects structure, not smooth acceleration. The question of what these prices mean relative to history depends entirely on how you measure. The 1980 silver peak of $50, adjusted for real inflation using shadow stats methodology, translates to roughly $1,639 today, implying a 32.78 adjustment factor. However, that January 1980 spike was driven by the Hunt brothers and the Soviet invasion of Afghanistan, making it an outlier rather than a representative average. The mean silver price across the 1970s was $4.12, rising to $5.65 when you include 1980, which, when adjusted by the same factor, suggests a range closer to $135 to $185 in current terms. The point is not where price should be. The point is understanding what distortions existed then and what constraints exist now. What's more interesting than historical adjustments is what's happening institutionally in real time. JP Morgan has been contacting clients who hold silver positions and recommending they rotate into gold. On the surface, this could be framed as prudent risk management given that the gold-silver ratio has compressed from above 100 about a year or year and a half ago to just under 50 now. So a rebalancing argument is plausible. But the timing raises a different question. Silver's underperformance since hitting 117 yesterday coincides with these conversations, and the question becomes whether JP Morgan is performing fiduciary duty or managing its own exposure. This is not a retail story. We don't know exactly what JP Morgan's silver book looks like, whether they're holding large positions for clients, or if they're carrying a substantial short that's now under pressure as silver accelerates. There are claims, some circulating from older sources and AI-generated videos, suggesting short positions as large as 2 billion ounces, but verifying that is not the priority here. What matters is behavior. If bullion banks are concerned, it's not because of price alone, it's because silver is moving faster than they can manage flows, and that suggests positioning stress rather than directional concern. Institutions don't chase price, they manage exposure. Silver has functioned as commercial currency and money for thousands of years. It was sidelined for half a century in terms of monetary use, but the institutional memory remains. The etymology of money itself reflects this. The US dollar traces back to the Spanish dollar, which derives from the Joachimsthaler, a silver coin. In French, money is argent, which is silver. In Spanish, it's plata. In Portuguese, it's dinheiro, from the Roman denarius, another silver coin. The linguistic record shows what the metal represented before modern monetary systems displaced it. Yes, silver is now also a critical industrial metal, but its monetary heritage is embedded in balance sheet thinking, even if the public narrative has moved on. Are you seeing the same divergence between market pricing and physical availability? If this type of market fixation is useful, consider subscribing so you can follow how these signals evolve over time. The conversation around confiscation of gold and silver keeps resurfacing, and it's worth addressing with precision. In 1933, Executive Order 6102 required Americans to surrender gold above a small exemption, 5 $20 gold pieces, which is just under 5 ounces. Citizens had to turn in their gold to the local Federal Reserve branch in exchange for $20 in Federal Reserve notes per ounce. The enforcement mechanism was not technically confiscation in the literal sense, but the penalty for non-compliance was arrest, imprisonment, and a $10,000 fine, which was enormous at the time, so coercion was absolute. The legal basis was the Trading with the Enemy Act from World War I, repurposed to justify the action. The critical context is that, in 1933, gold was money within the domestic monetary system. The $20 gold piece was fixed at $20. After the order, the Treasury revalued gold in January 1934 from $20.67 per troy ounce to $35, capturing a windfall while holders of Federal Reserve notes absorbed the loss. The confiscation was necessary because the Treasury needed to stabilize itself, and it worked because gold was structurally part of the system. The domestic gold standard was destroyed, and the public was left holding paper. But that system no longer exists. Gold and silver are not part of the formal monetary structure today, which means the incentive for direct confiscation is absent. Governments can print freely without needing to remove gold from circulation to manage the money supply. The de facto confiscation happens through currency debasement, inflation, and the erosion of purchasing power, not through legal seizure. Politicians didn't fail gold, they betrayed the public by abandoning the discipline it imposed. Alan Greenspan wrote about this in Gold and Economic Freedom in 1966, explaining that statists hate the straitjacket of gold because it limits their ability to wage war or expand the welfare state without immediate public backlash. If gold is money, citizens can withdraw it from banks, forcing fiscal discipline. Without that constraint, printing becomes policy, and the price of gold and silver rises internationally as governments need them for settlement and reserve management even if they're not used domestically. The difference now is that gold and silver will be needed globally, not confiscated locally. The system doesn't require taking your metal, it just requires devaluing your currency until the metal reprices, which is what's happening. Watch the flow, not the headlines. When I started accumulating gold and silver years ago, I expected the system to unravel much sooner, particularly after the 2008 crisis. But the timeline extended because central banks had more room to expand balance sheets than I anticipated. That delay doesn't change the outcome, it just stretched the adjustment period, which is why volatility feels sudden now, even though the structural drivers have been building for over a decade. The lesson is to remain calm through swings. Avoid getting overly euphoric during rallies or despondent during corrections, and maintain conviction in what gold and silver represent. They are not human inventions subject to policy revision. They come from the earth and have served as money across civilizations because of properties that don't change. The question you should ask yourself is whether you want to store the cumulative product of your labor in a form controlled by institutions with questionable commitment to your interests, or in a form that has retained value independently of political decisions. That's not a speculative position, it's a structural one. The public narrative lags the positioning. What we're seeing now in silver is not a reaction to headlines, it's the market pricing in constraints that institutions are already managing privately. JP Morgan's client outreach, the velocity of the move, the sharp intraday corrections, all of these point to positioning stress, not speculative excess. Silver doesn't move first, stress does. The metal is responding to flows and balance sheet adjustments that are happening in real time. And those flows are visible now even if the explanations won't be mainstream for months. The current moment is not an endpoint. It's an early structural phase where the market is beginning to reprice metals based on their role in a system that is slowly losing confidence in paper claims. Confiscation fears, distract from the actual mechanism, which is monetary, not legal. Governments don't need your gold and silver, they need to devalue their liabilities, and the price adjustment in metals is the symptom of that process, not the cause. What aspect of this silver move do you think the market is still misreading? This is a long-term repricing, not a short-term trade, and understanding the distinction between positional shifts and speculative runs will matter as this develops. Stay focused on what the structure is telling you, not what the commentary says after the fact.